I've got one client who has a fair chunk of money invested into whiskey casks, which is great. Doesn't drink whiskey, but a lot invested into whiskey casks.
Welcome back to Money Illuminated, the podcast where we talk about investing, planning, and making confident decisions with your money. In today's episode, we're going to be talking about the foundations of investing. My name's Elliot West, and I'm here with my colleague Jack. Welcome, Jack. How are you today?
I'm all good, thank you. Minus the absolute mare we've had trying to set this up. I'm all good. How are you?
Good, thank you. Not been my finest moments on technology today, but thank you everyone for joining us with the foundations of investing. We're going to be talking about why we invest and also what do we invest in terms of pensions, ISAs, and other investment vehicles. So kind of give us a bit of an introduction as to what to expect in today's episode, Jack.
Yeah, I think, well, it's a general chat really around the core foundations of investing, the kind of principles, the philosophies that we follow, why we invest in the first place. It's something that I think most people that come and speak to us know that investments is going to be a big part of the discussion and the planning that we do with them. But actually the core foundations of why are we doing this and what are we then investing into is really, really important. And it is something that a lot of people don't really have a huge understanding on. So if we can try and get a few points across around those different areas, I think that's going to be hopefully really helpful to everybody.
Yeah, very well said. And I think there's a few people that are a bit skeptical with investing, and they have reason to be. You hear a lot of different things from a lot of different people, especially people that aren't actually professionals in the industry. So I think a really good starting place is we've heard people talk about crypto investments, investing in wine, gold, all sorts. But I think a great question to kind of start us off today would be, have you heard of any really odd things people have invested in over your career so far?
I think the two that stand out immediately are I've got one client who has a fair chunk of money invested into whiskey casks, which is great. Doesn't drink whiskey, but a lot invested into whiskey casks. So that comes up every year when we go through his annual planning. Doing well for him. They have done well for him, but it's certainly not something I'd suggest to anybody in the future. And I guess the other one was I was talking to somebody last year who wanted to become a client, and I ended up saying that I don't think it's right for you, because all he wanted to do was invest all of his money into Rolls-Royce. And naturally, I'm sure we'll come on to it shortly, but I was very much trying to persuade him not to do that at all. But yeah, he had invested a little bit of money into Rolls-Royce, and they'd done some ridiculous sort of percentage number over 3 months. I think it was something like 50%, something like that, which is amazing, fantastic. But when he then went into the mindset of, okay, well, they're going to do that every 3 months for the rest of my life, I think that made him think it was a good idea to put all of his financial future into that one company, which, probably isn't the best idea in the world, it's safe to say.
It's one of those things you hear from Bob down the pub, isn't it? Of, I bought 2 shares of XYZ recently and I've got 10% in the last week.
Yeah, you do. You hear it all the time, and it's a more exciting story, isn't it, if it goes well? But unfortunately, there's a lot of chance that it isn't going to go very well. So we certainly don't do that with clients. Having a little bit of playpen money, I suppose, isn't a bad thing at all. But yeah, the majority of your financial security and future financial assets should probably be in things that we know always have worked and should always work in the future.
Completely agree. So I think that will lead us perfectly on to kind of the starter course, if you like, in today's episode of, why do we invest? And there's no one better place than yourself, Jack, as to kind of give us a bit of an overview as to why should people invest their money and what's the kind of key purpose as to why people do.
So for me, why do we invest? There's 2 or 3 key reasons for it. Number one is risk. And it's not the risk that people focus on with investing, because a lot of people think volatility risk and the risk of you losing money, etc., is linked to investing. And absolutely, both of those things are and can be linked to investing. But the reason we do it in the first place is to tackle arguably the 2 biggest risks we have throughout our lives, particularly in the latter stages of our lives. And that is inflation risk and the risk of running out of money before you run out of life. The way you tackle both of those things is by investing. right? So inflation risk is the fact that the cost of living, what we spend our money on, whether it's food, utilities, holidays, meals out, etc., all of those costs pretty much all the time go up. And sometimes they go up quicker than other times because inflation may be higher than it is at one point in time. But we know that if somebody's having a typical 3-decade retirement, even if you're getting 3% a year inflation on average over that time period, what you spend at 60 versus what you're spending at 90 is hugely, hugely different. It's absolutely huge, that difference. So we need to invest, just like we need our income to go up with inflation every year. We need our assets, our investments, our pensions, our ISAs, our savings to go up by at least inflation. But then when you go into the other risks, ideally more than that as well. And then kind of alongside inflation risk, I suppose, you've got the risk of running out of money before you run out of life. If you don't invest and don't get returns that are big enough to support a lot of what you're spending, inflation, costs and charges, etc., associated to whatever investments you've got, you do risk running out of money before you run out of life. Nobody really wants to be in that scenario. Okay, if you plan to spend every last penny and have nothing left by the time you get to the grave, unfortunately, then that's okay. If that's always been your plan, knock yourself out, go for it. But most people, if they've got family and friends, they want to leave a legacy. But yeah, you just don't want to be in a situation where you're 75 and actually you're down to a state pension and that's it. Because nobody's really going to want to be living a lifestyle where you've got £1,000 a month coming in, when we know really to have a comfortable retirement, you need 40, 50,000 a year, particularly if you're a couple, to be getting there. So yeah, inflation risk is a huge one. That's a big part of what we call the truth about money, is focusing on that. And then, the risk of running out of money too soon. That's a big one. The way you tackle both of those is to invest.
Yeah, completely agree. And I think holding a lot of cash, whilst it seems safe and nothing's happening to your money, it's not going anywhere, it is losing its true kind of purpose and wealth over time, isn't it? It's not keeping up with the cost of living and what you're going to need later on down the line.
Yeah, for sure. And people class cash as, well, the saying is, cash is king, isn't it? It's useful for certain circumstances, but it is going to lose buying power in real terms. And the issue is, we don't see, if you've got a bank account, savings account with 50,000 in it, you don't see the numbers going down on the screen. So we don't feel like we're losing money. But the issue is, what £50,000 buys you today won't buy you the same thing in 5 years' time, 1 year time, let alone 30 years' time. It's going to become smaller and smaller in real terms. So yeah, cash can be useful, but it's not an investment that's going to make your money last your lifetime for most people.
Certainly not. And I think the big struggle for a lot of people is, firstly, where to put that money, and we'll come on to that in a moment, but also when to start. And I think that can be the hardest part for someone, because there's so much negativity in the news all the time. When is the right time to put your money in the surf on the face of it, kind of in a risky environment?
Yeah, I mean, there isn't a lot of financial education around this stuff, is there? And you do always hear horror stories. It's very rare you hear stories coming out that people have made loads of money and have lived their dream retirement through investing. And we're not here to try and make people loads of money. That's not what we're there to do. We're there to make sure that the money people have and do create covers the lifestyle that they want to have moving forward. But what you do hear about is footballers. I think Danny Murphy has been in the news recently for having financial advice back when he was a Premier League footballer, and just losing so much money from investments. And people will attach to that. They'll click on that. They'll open it up a lot more. Similarly, when the market goes down, it's part and parcel of investing, but the market going down 2-3% is more exciting to read about than the market going up 1%. So it's noise. We want to try and listen to the media as little as we possibly can. Really difficult to do that, purely because of just the fact that people do trust the media, and it's there all the time. You get your notifications on your phone now. Used to be in newspapers and things like that, and some people will still read them. You've got to be confident in why you're investing and why it's a long-term investment, which it is. If you're putting money away for your financial planning throughout retirement, that's not short-term, that's multi-decade investing. If you're starting in your 40s, it's multi-decade investing. If you're starting to have some sort of investment journey in your 60s, it's still multi-decade investing for most people, right? So you've got to have that mindset with it and try and avoid the negativity and the noise that comes from the media and focus more on what this is doing for you over the longer term. And trying to avoid that panic, that's the difference between a successful investor and somebody that, tends to see the negative side of it too much.
It's very much, I guess that's one of the key parts of investing. It's got to be a plan you're going to stick to, and you're not going to panic at the first time of trouble.
Yeah, for sure. We've got a few investment principles, but I guess the whole underlying philosophy that we have with investing is stick to the plan. If you're able to do that, you are going to have success with what your financial planning is, and you should hopefully be able to live that life you want to live for as long as you want to live it for. Making regular decisions and changes to how your money is invested. You can get lucky and it can work if you are lucky, but are you going to be lucky enough consistently over 2, 3, 4 decades? I'd question whether that's likely to happen.
For sure. For sure. No, brilliant. No, thank you very much for kind of opening up about that. I think it's important. And the fact of the matter is, yesterday was the best time to start investing. So really, it's trying to speak to someone about what's the best way, or what's the way that brings in not necessarily risk, but a structure to say, I am going to stick to this. I'm not going to panic at the first time. I think that kind of brings us perfectly onto what we class as Clarity Corner, which is really the kind of bulk or the main topic of our discussion today. And it's, what should people invest in, or what do we invest in anyway as a company?
Yeah, so typically, well, it kind of breaks down into two things, right? You've got the instruments or the vehicles that you invest into, which people most commonly are going to know as pensions, ISAs, maybe general investment accounts. There are other investment vehicles out there, but those are probably the three most common that we see, at least. But then within those vehicles, you've got the actual underlying investments. You can own direct shares, direct stocks in companies. You can own cash. You can own property and so on. You've got all of these different options, gold, commodities. You could go on with loads of them.
Whiskey.
Yeah, exactly. The main ones, though, that you, or we at least, are going to be helping people explore are cash, bonds, and then equities, stocks and shares. What are those things? Well, cash is relatively straightforward. It's money in a bank, a savings account, premium bonds. You can get money market funds with pension providers and ISAs and so on. But typically people refer to cash as cash in the bank or a savings account, right? Or physical cash that still exists, which is surprising, right? Bonds, that's effectively where you're loaning money to a company or a government and they're giving you interest in return, right? So you can have higher and lower risk bonds in the sense of if a brand new company starts and you take out a bond with them, that's going to be slightly higher risk because there is a chance that that company doesn't succeed. Whereas if you're taking a bond out with a really secure government or a really financially secure company that's larger and higher performing, it can still go wrong, but there's less risk that it will, right? There's not no risk, there's just less risk. So bonds, you typically get lower returns, but there's also less volatility. So less up and down daily movement, but that results in a lower level of return, particularly over a really, really long period of time. You've then got equities or stocks and shares. What's that? That's essentially you owning a very, very small amount of a percentage within a company, or ideally, the way we invest is in funds that are really highly diversified. So instead of investing into an equity fund which buys 50 companies, the funds that we would invest into might be thousands, if not tens of thousands of different companies spread all around the world. And what's happening there is because you own, albeit a very small amount, but because you own part of those companies, you're going to benefit when that company performs really well. You're also going to see the downside when the share price falls. there's loads of stats and data around what happened and when has it happened and what are the trends and so on. The reality is nobody has a crystal ball. We have absolutely no idea what the markets are going to do tomorrow, the day after, the year after, in 10 years' time. But what we do know is that looking back over, hundreds of years, really, the market has always gone up over the long term, right? There are periods where it goes down, and sometimes it's going to go down for 2 weeks, 2 months, 2 years, could even be longer than that, right? We've seen that happen with the dot-com bubble, the global banking crisis, etc. And when it goes down, it might go down by 2%, it might go down by 20 or 50%. Nobody knows. And how long it's going to take to come back up, again, nobody knows the answer to any of those questions. Anybody that pretends they do is just lying to you, right? Nobody knows the answers to those questions. But what we can see from history is that whilst it does have those periods where it goes down, more often than not, it goes up. It's about 3/4 of the time the market's advancing, and about a quarter of the time it's declining, right? So when you can look at that and take a kind of, I guess, a structured view as to what level of investment into equities versus bonds versus cash do you need specifically, you can then have a portfolio that's tailored towards the plan that you need and getting you the returns that you need for your lifestyle and what you want to achieve within your financial planning. Yes, equities are deemed to be higher risk investments. We don't like that terminology at Illumity because that's true if you're looking at one risk, which is volatility, but actually equities are probably lower risk against inflation. And if that's the bigger financial risk for people over a 3-4 decade retirement, that's probably the one you want to focus on a little bit more than short-term volatility. Yes, it can go down, but we know that that's where returns come from. And you compare that to bonds, for example. Bonds have produced returns over the last 30 odd years, right? The average is just over 5% a year when you look at the global bond market. But the average for the global equity market over that same time period is over 9% per year, despite going through the dot-com bubble, global banking crisis, COVID, Brexit, Russia and Ukraine. That you could list hundreds of things. You could go on for ages. There are always going to be things which impact the market's performance, etc., in a negative way. But you've got to stick to the plan, and the more you stick to the plan, there's less decisions for you to make when the market moves, and therefore there's less mistakes that are going to be made. And that creates, financial freedom and peace of mind.
Absolutely. And I think you can talk about allocation. We can almost have a separate episode. We could have multiple episodes on allocation and what's the perfect split for each person and different stages of life and all those questions that are attached. But I think the point you made about diversification is really kind of highlight there. Equities is a very scary word to a lot of people. Shares, very scary word to a lot of people. But the way you can invest nowadays, the way you can spread it and diversify that fund that you're investing in really minimizes that risk, I think.
Definitely does. Yeah, diversification is a key point. And why do we do it? It is to spread risk, but it's also to spread the opportunity of return at the same time. Again, we don't know if we're going to have a repeat of the tech bubble during the dot-com bubble, right? We don't know what's going to happen. We don't know if one area of the globe is going to be better than another for a long period of time. So trying to put that guesswork and that people power into doing that, it's going to cost people more. If you've got an investment fund which makes more active decisions, it's going to cost you more. It's going to take away more of the returns that you may get. But B, it's just spreading that risk means that you've got the good from all of the different areas as well as the bad, right? But buying the haystack as we explain it, we can try and find roughly where the needle is in the haystack, the needle being those companies that might produce bigger returns. But it's going to be really difficult to do that consistently. And you might get it right, and you might get it right a little bit. You might get it right for a really long time, but are you going to get it right enough over a typical 3-decade retirement? It's just really questionable as to whether you will or won't. And I think I'm a relatively smart guy, but I'd have absolutely zero confidence in being able to do that. It's like me when I go to the horses, right? I'm absolutely terrible at picking the winners. I'm not going to be doing that with my clients' money. That's for sure.
Absolutely not. No, thank you very much, Jack. I think to kind of finish off, what this episode really epitomizes is, a lot of people consider investing as gambling to some extent. And I think in our kind of myth busting minute, as I like to call it, can you kind of give an overview as to why that is a myth? If we are investing in the way you just described, can we cast that as gambling as such?
I think if you're going into an investment where it's really, really under diversified and it's too heavily weighted towards a handful of things, I think there's an argument to say that you are having a bit of a gamble, right? I see cryptocurrencies. I've got a very, very small amount of my money in cryptocurrencies, and I see that as almost gambling, right? I've got no confidence that it's going to do anything in the future. And if it does, fantastic. But I'm fully expecting that not to return me anything. And therefore, I'm classing that almost as gambling. But when you're investing into funds, pensions, ISAs, whatever it is, right, that is highly diversified, spread all around the world, different types of companies and sectors and regions, etc. That's not gambling. And the reason it's not gambling is because it's always worked before. Yes, there's been periods where it hasn't, but if you're just buying the global market with maybe a little bit of bond holding in there if you want to, and maybe you'll have a bit of cash, and perhaps another episode in the future is what kind of allocations do we put to each of those for certain scenarios. But that's not gambling. It's always worked before. It always will work moving forward, because ultimately you're investing in companies and people aren't just going to disappear off the face of the earth. If they do, it's because the world's ended and you're not really going to give a monkey's what your investments are doing if that happens, right?
Yeah, I think there's kind of three key factors towards, investing in a proper financial planning sense. And it's, the time horizon that you have on the side, diversifying the portfolio, and making sure you've got that kind of emergency pots elsewhere in case, well, when things inevitably do go down. And I think that's again, that can be an episode in itself, but I completely agree. I don't see investing in a proper way, in a structured way, in a way you're going to stick to, as gambling as such.
Yeah, completely agree.
Amazing. Brilliant. Well, I think that kind of wraps us up for this episode. Is there any other kind of tips or any extra pointers you could give to anyone listening today?
Oh, crikey. Any extra pointers? I think, well, general rule of thumbs, I suppose, don't try and time the market. Right, there's a saying where we say time in the market is going to be better than trying to time the market. So I really like that one. Look at things like your pensions, which is typically where most people are going to have money invested, sometimes without even realizing it's invested. But often people will stay within the fund that they've gone into when they join the pension scheme. It's often called a default fund or a lifestyling fund. Now, I'm not going to say whether they're right or wrong to be in, but everybody needs their own financial plan to decide whether they're in a good place or not. So it's definitely worth looking at things like that, because that can make a huge, huge difference to somebody's financial future if they really look into that. If you need help with this sort of stuff, obviously it does make sense to speak to professionals about it. It's just, yes, it's not free to have financial advice and financial planning, but if you're working with someone that you're really confident is doing the right thing with you, for you, then it's going to be worth its weight in gold, ultimately. And yeah, I guess not investing is something that, it's a mistake a lot of people make, right? But actually it's hugely, hugely valuable. So yeah, try and build a bit of confidence with it. And I guess another thing, actually, a final point is there's a really, really good book called Simple Wealth, Inevitable Wealth by a financial advisor from America called Nick Murray. Absolutely brilliant. And even after doing all of my exams, reading that really helped it sink into my brain. Actually, why do we do this? How do we do it? And how do we help clients get the most out of their investments and their money? And it's fantastic. You don't need to be a financial advisor to read it. It's made for people. Yes, there's a little bit around why it's good to use a financial advisor at the end, but it's not there to try and sell that, right? It's just a really, really good, almost Bible around investing. Yeah, really easy to understand. So it's not cheap, probably 50, 60 quid, but it's well worth its money. And everybody that's ever read it that I know of has always said how fantastic it is. They've never said, oh, I regretted reading that.
It's a brilliant book. And maybe that's a section we're adding to later episodes, kind of other suggestions that we have. There's lots of books out there. There's lots of videos out there as well that could really help people. But no, brilliant. Well, thank you very much for your time, Jack, today. Join us again for the next episode. And thank you very much for your time. This has been Money Illuminated.